It's going to be a test of how many people I can see in gallery view on a 27-inch, and I think I'm running out of space. So we're almost there, folks. Let's see, we're at, I'll give people a couple of minutes. First day. Zoom links are not always reliable. I'm glad you guys are not using those fake Zoom backgrounds and making it look like you're sitting in Washington Square Park. It's too much of a lie on a day like today. Okay, I think I'm going to get started because we're at pretty much 90% of capacity, and everybody else will join in when they can. But if this were a normal year, we'd be in Paulson Auditorium. Have you guys ever been there? Have you actually gone into school since you actually? So you've been in Paulson Auditorium. Have you been in Paulson Auditorium? Don't go in there. It's like it's got all the ambiance of Rikers Island, and you don't want to be in Rikers Island either. So I don't miss, to be honest, I don't miss Paulson Auditorium. It's like an amphitheater, and you feel like you're being fed to the lions if you're in the middle there. But that's the only room I've actually taught in for the last 20 years at Stern. But so at that level, it's good. But at the other level, I do miss being in a classroom. There are things that you cannot do online, and you know that already, that you could do in a classroom. So I really, really miss being able to see you guys in person. But that said, I'm in 65-degree weather today and you're in snow. So maybe that's a saving grace for me, is I can be in La Jolla, look at the ocean, and give you my lecture from my office. So let's get the show on the road. I mean, it's I would assume that almost everybody in this class is a first-year MBA. But let me get this straight. Is there anybody here who's not? You can use the hand raise function. How many people in the class are not first-year MBAs? Nobody?
Myself.
Michael? Yeah, Alan? Okay, there are quite a few. Okay, hand raise. I can see there, but no. But this is a class that you're getting pretty. I mean, it's no matter where what program you're coming in for, whether you're first year or second year, it's a class you're getting pretty early in the process of going towards your MBA. And people come into this class with all kinds of preconceptions about what this class is going to be about. So you can put your hands down. I just wanted to get a sense. Normally in a class, we'd put hands up. We could, So I want to spend today talking about what this class is about and what it's not. Dispel some delusions if need be of what you think you're getting into. And maybe you'll re-examine whether you want to take this class in the first place. Just to give you some sense of, of this class itself, I taught it for the first time in 1986, fall of 1986, when I came to NYU. It was my first year teaching the class. But actually, I taught it 2 years earlier at UC Berkeley. It was actually the very first class I actually taught as a teacher. And your classes are like your children, and you're not supposed to have favorites, though we all do. But corporate finance is my favorite class. It is, to me, the bedrock class. If you get this class, everything else about finance kind of flows in. So what I'd like to do today is spend about 25 minutes on logistics. And the logistics are obviously going to be very different this year than in a typical year, because everything's going to be on Zoom. So if you look at in terms of getting in touch with me, obviously you can't walk up to the 9th floor, or you could at Stern, but I won't be there. So the only way you can catch me is online. Luckily, I'm easy to find online. This is one of the problems with having an uncommon name, is I can't claim you found the wrong John Smith, right? I mean, it is what it is. So, so there are plenty of ways you can catch me online. You can, but the most obvious one is to email me. And I'm pretty good about responding to my emails. So, if you don't hear back within a couple of hours, within 3 hours, get back with me, because it might be just that I'm mowed down by a bunch of emails that day. The office hours are going to be on Zoom as well, and they're going to be before the classes on Monday and Wednesday. As I mentioned in my last email, I'm teaching 3 classes back to back. So this class ends, I start my valuation class 10 minutes later, and after the valuation class ends, 10 minutes after that, I start my undergraduate class. So because of that, the class are all backed up, but the hour before, which would be 11 to 12 New York time. And I'm going to be very specific whenever I can about time, because a few of you are in time zones that are 12, 13 hours away. Now, thank God there aren't that many, but clearly, so when I say tomorrow, that can be very confusing to people, because it might already be tomorrow for you if you're in Australia or in Hong Kong. So the 11 to 12 New York time on Mondays and Wednesdays will be office hours. The problem with office hours online, though, is you come in, there could be 30 people in office hours, and you might have a question you don't want to ask in front of everybody else. So if you ever use breakout rooms in Zoom, I'll create breakout rooms in case you want to talk to just me and you don't want the rest of the world eavesdropping. So it'll be Mondays and Wednesdays. The TAs for this class is Sam Green and Siddharth Kejriwal, both of whom took this class last year. They're intimately familiar with the torture that I will put you through. And so any questions you have, I'm sure they'll be able to answer. So I'll put their office hours as well on the class Zoom session so you can know when you can. And they will have one session every week where they will cover, problems, questions from, it'll be practical, which will you take the stuff we did in class and work through problems, because I'm not going to spend my time talking about how to price a bond in class from step 1 to step 10. I mean, that's not what the class is for, but they will take you through the mechanics of applying stuff. So that's that's the structure. There's a principle called the fair game principle that I used to have in my class, and I'll try to adapt it to online. The fair game principle in a regular class, when I taught it last year or the year before, would be if you find me, I'm fair game. So at Stern, this became a little game, which is I would never take the elevator, I'd take the stairs. Why? Because MBAs don't take stairs. They take the elevator, they don't ever find. So if you find me, you can ask the question. And the same thing applies online. If you can find me, I'll ask the question. You don't have to reserve your questions for office hours. You can, 11 o'clock at night, say, I'm stuck on something, I have a question, you email me. Luckily, I'm 3 hours behind you, so it's still 8 p.m. for me. I should be able to respond to most questions. So if you find me, I'm fair game. Now, if it feels like you've had me already for a whole semester, it's because I've been emailing you every week for the last 4 weeks. If you haven't received those emails, you might want to check your registration, make sure you're in the class, because you should have been getting those emails. Because I'm just using the Google Mail, the Google Class email list, which is if you're in the class, you should be getting those emails. If you have a elaborately designed junk screening program and I'm being screened into junk, please unscreen me and put me in your regular email, because some of the stuff I need to let you know about the class, I will let you know by email. So there have been 4 emails, and in the very first one, I kind of held your hand, said, if you've never taken finance, if you're not a numbers person, if your background is maybe in a nonprofit or a marketing or strategy, and you're really scared about the class, and you're saying, what do I need? I said, there are 3 skills. I won't even call them skills, basic learning that you need for this class. The first is you need to be able to read a financial statement. If you still have trouble differentiating between net income and operating income or gross income, you need to get that out of the way. I don't want you to be accountants. I don't want to be an accountant. I hate accounting. But let's face it, the raw material we need in finance comes from accounting, which is one reason I created a mini accounting class, and I sent you the link. If if you're still hazy about accounting, I would encourage you to take it. It's about 12 sessions altogether. It's 4 or 5 hours altogether. But it basically gives you what I think matters in accounting, which is about 3% of what you take in an accounting class. Personally, I think most of accounting is a waste of time, because you're delving into distractions, levels of detail that nobody cares about. So I focus on the 3% that matters. So accounting is the first. The second is we live in a world where data is too available. That's a strange thing to say, right? 30 or 40 years ago, you had to go looking for data. I remember the first time I did a corporate financial analysis for a company in the early 80s. You know what I had to do? I had to write to the company for an annual report. Write to the company. You say, why don't you go to sec.com? There was no, I'm sorry, sec.org. There was no SEC online site. Today, we're drowning in data. And one of the tools that's most effective at dealing with data is statistics. But here's the bottom line. I'm sure every one of you has taken a statistics class as an undergraduate, perhaps even a statistics class at business school. You know the problem with statistics classes is the people who teach them seem to be so caught up in statistics and not in the applications that by the end of the class, your reaction is, Thank God I would never see that again in my life. And you sell the book back 15 minutes after your final exam is done, saying, that's it. That's unfortunate because statistics provides us tools. So basic statistics, again, not the advanced statistics. You know the difference between an average and a median. Why would you use one over the other? What's a variance measuring? Basic statistics. And of course, basic finance, which is supposed to get in your foundations class, which some of you might be taking simultaneously because Stern allows you to take both. Don't worry, there's not that much in foundations that I need. What I need is, can you do present value? That's a pretty straightforward skill set, right? Cash flows, discount rate, can you do present value? Do you know the difference between a stock and a bond? I'll kind of review some of those things in this class, but I'm going to assume that you know that. And so that's the pre-season prep. But since we're already in the season, you're saying, what's the point? Well, you can still catch up on things that you feel weak on. A little bit about this class. In my very first email, I threatened you. I said, I'm going to take over your life for the next 15 weeks. You know what? I'm going to try. You're going to pretty much hear from me every single day from today through May 10th. And here's how it's going to play out. Mondays, we will have class. Later today, you will get an email about the class. You're saying, I was in the class. Why do I need an email about the class? Because you might have missed the class, or you might have been in the class physically, but mentally you might have been somewhere else. Or you might have, early dementia, in which case you forget everything, 15 minutes after the class is done. So I'll remind you, hey, this is what we talked about, and give you a couple of suggestions on things you can take out of the class. Tomorrow, you will get what I call the corporate finance puzzle of the week. You're saying this is going to be very, very complex. No, I'm going to take something in the news that week and send it to you as a puzzle. So, and basically what I mean by a puzzle is, hey, this is what's happening out there. Why do you think it's happening? I've been thinking about what the puzzle of this week should be. Maybe it should be GameStop. And you know what the puzzle I'm going to pose is? Well, clearly GameStop stock price was $5, $10, $15 you heard about the GameStop frenzy, right? You'd have to live under a rock to not hear about it. As recently as 4 weeks ago, people were convinced that this was a company that might not make it for a good reason. Why is GameStop in trouble? Nate, you want to?
Nate, me?
Yeah.
Yeah. The question is, why was GameStop in trouble?
Mm-hmm.
Yeah, they're an old style retail shop specializing in selling and trading in games. So that's not exactly.
And we're not going to malls anymore, and COVID made it even worse, right?
Yeah, not exactly suited to 21st century.
So if this were a crime and GameStop were dead, and it's a morbid thought, who would you arrest? I mean, you can, of course, go after Melvin Capital and say, you guys did it. And maybe they stomped on GameStop's head when it was down. But you know who killed GameStop? It was online retail and online gaming. People spend more time on Fortnite, which you don't go to a GameStop to buy, than they do on a game they don't buy. So GameStop is in trouble because its business model was breaking down. Now, of course, in the last 2 weeks, you know what's happened to GameStop stock price, right? It's gone from $20 to $400. Now, here's my question. That increase in stock price by itself doesn't benefit GameStop, right? If somebody's paying $400 per share for GameStop, it's not like GameStop is collecting the money. It's between trader A and trader B. Somebody's winning, somebody's losing. But I have a corporate finance question. Are there benefits to GameStop from its stock price going up 20-fold? Start thinking about it. That's a puzzle for tomorrow, because I'm actually going to post on this. I'm going to call this the feedback loop. When your stock price goes up as a company, how do you benefit as a company? Let's throw that out. I mean, we said this is the start of the class. Let's use common sense. What is the first potential benefit of seeing your stock price go up? Is there a perception difference?
You can issue probably more shares and try to raise capital.
That's explicit. So let's actually hold that off. That's actually a good point. Who is it that said that? I'm sorry.
It's me, Sushant.
So if you look at so one of the things you can say was, why can't GameStop go out and issue more shares? When you raise more shares, cash comes in the company. It doesn't fix your business problems, right? Still, people are not coming into GameStops, but what could you use the cash to do? Pay off your debt, pay down your lease payments, take out the worry about default. You're going to benefit because you've reduced your risk. But there are also implicit effects. You know that GameStop, I mean, with AMC, this is true. You know what happened when the stock price for AMC shot up? Convertible debt that they had converted. So the worry you had about making interest payments went away. Implicitly, you didn't even have to do a thing. But I'll give you something we don't even think about. There's a perception effect. Let's say it's a year from now, you're looking at jobs. I hope you're looking at jobs. And you're looking at two potential employers. Let's say you know nothing about their financials, but one has seen its stock price go up tenfold in the last 5 years, and the other has seen its stock price drop 90% over the last 5 years. I know it makes, you're saying, I'm an MBA, I'm going to look at the numbers. But let's say you just looked at those two facts. Who are you more likely to go work for? Tesla or GM? Airbnb or Marriott? You're saying that makes no sense. If their business problems are business, why do I care about what? You know why you care? Because you might get options in the company. So that's going to be what the puzzle is going to be about. I'm going to throw something out there, and I want you to think creatively, and you don't have to turn in anything. This is for you to kind of build your corporate finance skills. I'll, of course, create a discussion board where you can talk to other people who might have it. Much of what I will do in this class is optional. The quizzes are not, the exams are not, the project is not. But I'm going to kind of add stuff on where if you're interested, you can go further. But if you have other things to do in your life, I completely understand. You're saying, look, I'm not a marketing person. I'm sorry, I'm not a finance person. I'm a marketing person. My sympathies to you. I'm going to try to convert you over the next 15 weeks into a finance person. But you might say, look, I don't want to dig any deeper. I'm just going to look under the surface and I've got what I need to get. I'm okay with that too. So every Tuesday for the next 15 weeks, you will get a puzzle. And you can think about it for the following week. And that puzzle is going to be grounded in the topic for that week. On Wednesday, of course, we'll have another class. And we'll have another email about that class. On Thursdays, you get an email about your project. You're saying, what project? We're going to talk about it. As I said, your project has already started and you even know it. You know what your project is going to be? You're going to pick a company, any company you want. And everything I do in the class, you're going to do on your company. Don't worry. This class, as I said, I've taught for 30 years. I will drag you across the finish line. Even if you say, I'm not ready. And Thursday I'm going to do. So this is going to be my nagging email because I know exactly what's going to happen. Every week, I'm going to beg you to keep up with the project. I say, you should be doing this in the project this week. And every week, you know what you're going to do? You're going to ignore me. Why? Because you said, look, I can get to it next week. So every week I'm going to nag you and say, are you on board? Are you? So in fact, I'll send you a little timeline with a little arrow that says, this is where you should be on the project. I know you might not even be started on the project, but if nothing else, I hope that arrow kind of prods you into saying, hey, you know what? I need to catch up. On Friday, I'll send you a link to an in-practice webcast. Basically what this is something we did that week where you say, well, how would I do this from scratch for a company? I'll give you a preview. Next week, we're going to talk about corporate governance. You know what corporate governance is? The question we're asking is, where does the power lie in my company? Remember, the old saying about power abhorring a vacuum? In every company, there is power. Somebody holds the power. It could be insiders. In the case of Facebook, we know where the power lies. Jane, where does the power lie at Facebook?
With the executive team.
Make it even more focused than that. It lies with Mark Zuckerberg. We can dance around this as much as we want. It lies with Mark Zuckerberg. Why?
He has
Not
special
because
shares.
Not because he's the founder, that's part of it, but because he controls 57% of the voting rights in Facebook. He doesn't own 57% of the shares, but he controls 57% of the voting rights. Because there are two classes of shares at Facebook. One class has 10 times the voting rights of the second one. And guess what? Zuckerberg owns a lot of that. Does that make him a bad person? No. But it does mean that when you think about Facebook and you say, how much power do I have as a shareholder? The answer is not that much. If I ask you, where does the power lie in Alibaba? A year ago, you'd have said it lies with Jack Ma. Today, I'm not so sure. I won't get into deeper details, but maybe it lies in Beijing and we didn't even know it. So next Friday, what I will do is I will put a webcast on. If you are looking at a company, how would you assess where the power lies? What would you look at? So I'll take you through what I look at that the company has filed with the SEC. I'll read the annual reports. And this is the part of the annual report that I use to make my judgment, because it is a judgment. So every Friday, you will have a webcast on something where you get your hands dirty with that company. It's really designed to go with your project. And what I'm hoping and praying will happen is you'll watch that webcast and be so inspired by it. Zero chance of that happening, but so inspired by it that you will take your company, remember the one you pick for your project, and do that, whatever I did in the webcast, on your company right away. The nagging has already started. On Saturday, you get a newsletter. And I'll tell you something, there is no news in the newsletter. But here's what it'll tell you. Here's where we are in the class. This is the page in the lecture notes we're in. Here's where you should be on the project. Here's some of the things we did this week. You know why? Because I've sat in on really large classes, and this is a big one. And after a while, it's easy to get lost. You get a couple of weeks, you have something else that day, and you forget where this class is. Where were we? So this is like Netflix. You know how you leave a show mid-show and Netflix keeps reminding you, saying, hey, guys, you left in the middle of the show. Do you want to come back? The newsletter is more a prompter of here's where we are in the class and here's where we're going. So think of it as a GPS for the class. On Sunday, I'll send you an email with here's what's coming the week ahead. So that pretty much covers all 7 days. I might give you a break during spring break. Where are you going to go anywhere? No. So you might get no emails for 5 days, but basically you're going to see me nagging or trying to nag you all through this class. Now, obviously, the difference this semester is we're not going to be in a physical classroom. We're going to be on Zoom. And that comes with a few issues, right? One is, of course, broadband, which is there will be times when your broadband will fail, which is not catastrophic, but there will be times where my broadband can get shaky, which can be catastrophic. I have all kinds of backups built in, but you can have backups of backups of backups, but still blow up. I need you as my sounding board. So if you, for instance, notice that I'm starting to lag, something's happening, I need somebody to put up their hand and say, something's happening, turn off your video, because sometimes that's all I can do is turn off the video so that because the audio still comes through. There's also the issue of you're in a different time zone. I can't ask you to wake up at 1:30 in the morning and watch this class. Or I can, but it's not right. So if you're in Hong Kong or you're in Sydney, the reality is that you're paying full tuition, but you can't sit in on the class. So the class will be recorded and it'll be available in multiple places. It'll be available, of course, as a Zoom recorded session on NYU classes. It'll be available on my website as a link to both that Zoom recorded session as well as a downloadable MP4 file. Why? Because the problem with the Zoom recorded session is you got to be online while you watch it. What if you want to, I don't know, go somewhere outside? How far outside can you go? I don't know. But maybe you want to take a recorded version of it. And I also will make a YouTube video of it because especially if you have troublesome broadband, the great thing about YouTube videos is they adapt to however strong the broadband. So there'll be multiple places you can. I'll even make an audio file. If you want to go for a jog and listen to my lecture, that sounds like torture, but if that's what you want to do, I'll make that as well. Everything you need for the class will be a link to that session, the lecture notes, every class I will have a post-class test where you can take it's like, it'll take you 5 minutes, do you get this stuff in the class? In terms of Zoom rules, you're already following them, which is if you could turn your video on, I'd prefer to see your faces because it's kind of depressing to watch a lot of gray boxes. So I know for some of you, this might not be what you want to do. You might not be fully dressed, in which case, please don't come on. No, but if you can, you don't have to be dressed up. Well, I'm not going to dress up for you guys. Why do you need to dress up? So if you're in jeans and a t-shirt or even your pajamas, I don't care. But I'd prefer to see you than not see you. And in terms of class discussion, to preserve some degree of order, if you have a question, of course, you can put up your hand. If I call on you, then you can. I'll try to use full names. Obviously, if I use first names, which it might be a little confusing. But I might call on you. But if you have a question, you want to create a discussion, just put up your hand and treat it like a regular classroom. In terms of where you will find the information for the class, I've sent this link before, but I'm not a great fan of NYU classes. Why? It's a closed system and I don't like closed systems. I didn't like Blackboard before that. But this semester, of course, I have to use NYU classes for some parts of the class, like the Zoom sessions. But most of the material for the, in fact, all of the material for the class is also online on my website. So you go to the entry page for this class, and I've sent you the link multiple times. You can pretty much find everything you need for this class. And as I said, the YouTube videos for the class will go into a YouTube playlist with the links in the YouTube video as well. Now, I don't know whether I should tell you guys, but I'll tell it to you anyway. I know you're paying full tuition and you get this privilege of sitting in or whatever. I don't even know whether I can call it privilege, sitting in the live class. But there'll be about 100,000 people taking the class with you informally. And I've been doing that for 30 years. This is not something I started in 2020. Which is I've always recorded classes, I put them on and people can watch the recordings, download the slides. Of course, they don't get any credit for the class, but they don't pay for the class either. So there will be 100,000 plus whoever's in this classroom right now taking the class. So I will try to keep the material accessible. I'm not done harassing you. There's a link to a Google Calendar that I sent out so you can see when the quizzes are, when the final exam is. So there should be absolute transparency about when things are due. You've already got a few links on from my blog post, and I tend to post almost entirely on finance, whether it's corporate finance, investing, or valuation. So I would encourage you to kind of follow along there because much of what you're seeing in the class you'll see played out in real-time events, on those posts. And finally, I do have a Twitter feed which you are welcome, unless Twitter somehow decides to ban me over the course of the semester. It's what I use to kind of draw. I don't send out big messages on Twitter. I just use it as an indicator. I just posted on my blog, here's what I did. So kind of keep up with what you will see out there. In terms of the material you need for the class, I don't want to be bulldozing through. Any questions so far? Okay. In terms of material, the primary material is the lecture notes. There will be 2 packets for this class. The first packet is already available to download. I sent you the link, right? So you should have got that. If you did not, you should be able to find the link from the main site, multiple places. So download those lecture notes. If you need to print them, you're welcome to, but if you want to just keep them on your iPad or your whatever device so you can watch, because those slides will be useful. So you don't have to kind of take notes on things that are already on the slides. If you really want to get a textbook, there is a book that actually, in fact, this is a book that parallels the course. I'm not sure which gave birth to which. I think the course gave birth to a book called Applied Corporate Finance. The 4th edition kind of will capture everything you see in the class. So if you prefer a textbook, the downside is it's a textbook. You know why that's a downside, right? Because the US publishing industry has this racket called the textbook racket, where a textbook costs you about 2.5 times more than a typical book because they know they have a captive audience. I wouldn't suggest ways you can get around it because that would be perhaps illegal of me to do. But if you don't want to get the book, I'm okay with that. I've never required this book for my class. If you can find it used, if you can do whatever you can to minimize your costs. There'll be practice problems, the links are there, and the spreadsheet and data we use for the class will be on my website as well. Ready? We're almost ready to start in the class. I'm going to start with a poll. You guys see the poll yet? All right, it should show up now. I'm going to give you about 30 seconds to pick. And you can use you can pick multiple answers if need be. Okay, I'm going to end the poll. I'm sorry if you haven't picked, I'm going to give you a minute more. Okay. Okay. So you guys can see what the results look like. So what are the 2 things that you decided were primarily not corporate finance? One was ESG, and we're going to talk about ESG, and supply chains. And the reason I think you pick supply chain is most of you, if you're not from that area, if I ask you what's a supply chain, probably have no idea what it is, right? I remember the first time about 10 years ago, or maybe longer than that, I got an email from somebody called Supply Chain Management Group of America or something. And they said, can you come in and talk to our group about supply chains? And I said, what's a supply chain? And why would you need me to talk about it? And they said it's about speeding up the process between getting raw materials and producing the goods, and from producing the goods to selling it. Oh, I said, okay, so you want to speed up the cash process and reduce your working capital needs and increase your cash flows. He said, oh, we haven't thought about it in that way, but I guess that's what it is. Hey, guess what? Supply chain management is really about reducing your cash needs and maintaining inventory and bringing stuff quicker. It is corporate finance. I noticed you said ESG is not, many of you said ESG is not. What the heck is ESG? I'm going to tell you up front, I am a cynic on pretty much every magic bullet in business. You know what I mean by magic bullet? Every decade, people invent a magic bullet. They said, this is the answer to every problem in business. And what they're doing is packaging the obvious and charging the outrageous, consultants, bankers. ESG is, of course, the flavor of the moment. Why do we want companies to be good? Well, we want society to benefit, but ultimately these are businesses. What's a sales pitch that people from ESG are making to companies? If you're good, you're going to do well, right? Because if that connection breaks down, the sales pitch is not going to work. People will pay lip service to ESG, but they're not going to do it. So let me cut to my slide. Do you guys have your, let me stop this. Do you guys have that week of the week before you start your MBA? Did you still have that networking week where you had different people come in and talk to you? No, what do they call it? Stern something, right? You know what I'm talking about? The
launch
like
week?
Launch.
I'm sorry, the launch week. Yeah. The week where you're told that everything you've learned in your life so far is kind of pointless, and what you're going to learn for the next 2 years is all that matters. Complete lie. But we've got to kind of program you to think it's okay to spend $200,000 for an MBA. So about 10 years ago, I was asked to be part of the launch week. They said, hey, you teach this corporate finance class, which pretty much every first year MBA ends up taking. Would you come in and talk to this entering MBA class about what corporate finance is all about? So I said, sure. And they haven't invited me back since, so I must have done something that they did not like. I came back with this chart. I said, this is my class, and you can see it. No, corporate finance up there. And I said, everything else you're going to do in this program is in service of my class. That accounting class, you know why it matters? Because it provides me with raw material that affects corporate finance. That marketing class, all this talk about product, price, promotion, all that stuff. You know why it matters? Because it shows up in my revenue growth and my margins. Oops, sorry. I'm kind of stuck here. I apologize. I've got this new remote and it's acting up here. There we go. Sorry about that. Okay. So I'm not going to press that button again. This will teach me not to have a new remote. This is this new Logitech remote where if you press a button, it highlights something on the screen. But for some reason, the highlight got stuck. So I said, everything you do in this program is in service of corporate finance. And you know what? I truly believe that. It might be just my ego or my feeling that this class is important, but everything is corporate finance. Marketing, public relations, ESG. This is a class about any decision that you make as a company that involves the use of money. Think about it. Is there anything that companies do that doesn't cost them money or doesn't bring them in money? Absolutely not. Everything is corporate finance. So with that set up, let's talk a little bit about the 3 objectives I have for this class. You know what, at the end of this class, I'm going to come back to you and ask you how well I did in accomplishing these objectives. So write them down because this is my evaluation of you is of course with a grade, but your evaluation of me is going to be on how well I do on these 3 objectives. Here's my first objective. I want this class to give you the capacity to not just understand the theory, but to apply that theory in the real world. This is an applied corporate finance class. The first time I taught corporate finance, 1984. The first time anybody teaches a subject, you know what I was given, right? I was given a syllabus for the class. I said, this is a corporate finance class. These are all the topics you're supposed to cover. And in 1984, I covered all the topics. Why? Because it was the first time I taught the class. But progressively, and not that long after that, I went through and said, why would I want to cover that topic? Who really cares? So here's my rule for what I will cover in this class. If it cannot be applied, I will not cover it. I don't care about theory for the sake of theory, models for the sake of models. This is an applied class. Second, it's a big picture class. The way I describe this class is I want you to elevate, be able to lift up and look at the big picture. I know everybody says this about that class, but I'm going to put it into real practice. So it's got to be applied. It's going to be big picture. And then I'll give you a third objective. And this is going to be the toughest one to deliver on. I think corporate finance is an incredible amount of fun. You think that's sick. It could be sick, but it's fun in the sense a crossword puzzle is fun, which is when things start to fit together, it's fun, right? You're seeing things fit together. And that's going to be my objective for this class, is to give you those tools where you're able to start to see things fit together. You say, okay, I see why young companies did much better than older companies during the COVID crisis. I see why companies should be buying back stock or shouldn't be buying back stock. So as I said, I'll come back and check to see if I can deliver on those objectives at the very last class. So now we're going to put our corporate finance hats on. Everybody's got to take accounting in the first semester, right? Is that true? Or you wave out of accounting? Accounting is behind you now, right? Thank you. That's good. So you don't have to deal with that again. But now that accounting is behind you, I want you to do a mindset change. I want you to take your accounting mindset, which is what accounting teaches you, and replace it with what I call a financial mindset. Sounds fancy, but let me be specific. To show you how accountants think, I'm going to show you an accountant's favorite statement, which is the balance sheet. Accountants actually think balance sheets matter. As somebody who's in valuation, who cares about value, it is the least important financial statement that accountants are. But accountants think book value matters, balance sheets matter. But let's take an accounting balance sheet apart so you can see how accountants think about the world. If you look at an accounting balance sheet, there's the asset side and there's the liability side, right? On the asset side of the balance sheet, you have long-lived assets, land, building, equipment, machinery. They're called fixed assets. How are they usually recorded on balance sheets? What is the rule that accountants follow for fixed assets? Morgan Schultz? How do accountants record fixed assets?
If it's been held for longer than 12 months, it's considered long-term or long-lived.
Mm-hmm. And how do they record the value? So if I take Coca-Cola or a GM and I looked at fixed assets and there's a number next to it, what does that number measure? If you don't know, you can just pass. You can say I pass, but no. But
minus depreciation.
what you originally paid for the asset, net of whatever they think you've lost in value. And the key word is what you originally paid. So if you bought something in 1975, what's the number going to look like? A really small number, right? Because it was 50 years ago and you paid a very different price. You think that makes no sense. Remember, accounting doesn't need to make sense. It just needs to make sense for accountants. And for them, this makes sense. You paid for it. That's what you invested. So fixed assets are recorded at what you originally paid for them. And land, building, equipment, machinery, etc. are fixed assets. If you have current assets, you know what I mean by current assets: inventory, accounts receivable, They usually recorded at original cost too, but because you didn't buy your inventory 30 years ago, with current assets, the numbers are closer to the truth. So fixed assets record original cost, current assets, even though the original costs are closer to current values because they haven't been around very long. I'm laying a foundation for something that I'm going to say about accounting. Then you have financial assets. What are financial assets? If you own 5% of another company, it's called a cross-holding. It's a financial asset. You know how accountants record financial assets? They're all over the place. If the financial asset is held for trading, you have to record it at market value. It's called mark to market. So remember that WeWork fiasco in September of 2019? A company run by an insane narcissist, backed by an even more insane narcissist. I won't name names, and you could fill in the names. Expected to go public at 90 billion and ended up not going public at all because it was worth close to nothing. You know who backed up WeWork, right? SoftBank was the venture capitalists who backed up WeWork. And because they had a holding in WeWork that was essentially held as for trading, they had to mark to market. Do you see the problem SoftBank had to face in December of 2019? An investment they told the world was worth 60, 50, 70 billion. They had to tell the world was actually worth 8 billion. And that's probably an overestimate of the value. So they had to rewrite that asset down to current market value. So if you're invest in a company and it is a minority holding that you're holding for trading, it's got to be marked to market. But if you invest in another company and it's not for trading, it's a strategic investment, you have to show what you invested and what you originally put in. I'll give you how absurd this can become. You know, there used to be a company called Yahoo, right? The reason I say used to be a company is, when was the last time you used the Yahoo search engine? Anybody here use the Yahoo search engine? Is there even a search engine? How much would you value a company which is a search engine that nobody searches on? And the answer is not much. So in 2014, I valued Yahoo. This was when Marissa Mayer had just come in and we were told she was going to rescue the company. I valued the company. I came up with a value of about 4 billion. Stock was trading at about 40 billion. You're saying that is crazy. You know what? The 40 billion was not a bad value. The 4 billion that I attached to Yahoo was for the search engine that Yahoo had, which was not worth much. But Yahoo had two investments in 2014 that were worth vastly more than the search engine. Anybody know what those two investments were? What did Yahoo own in 2014 that gave them extra value? Nate?
Yeah, I'm not sure.
No?
Yeah,
They
honestly, I
own
haven't
20
paid attention to Yahoo in a long time.
Is there
Because
is there share for Alibaba?
they own 21% of Alibaba, 21% of Alibaba, and 35% of Yahoo Japan, which is a separately traded company. For some reason, the Japanese still use Yahoo. Don't ask me why. And here's why I'm bringing that up. In 2014, Alibaba went public. You know what its market cap was at the time that it went public? About $200 billion. 200 billion. How much did I say Yahoo owned? 21% of Alibaba. What's 21% of 200 billion? Just give me a rough number. What, 42 billion, right? You think that should show up in the balance sheet? It did. It showed up as investment in Alibaba, 1 billion. You think that's crazy. You know what the 1 billion was? What they originally invested to get 21% of Alibaba. Internally, you can see why accountants say this makes sense. It's how I record land and building and equipment. That's how I'm going to do this. What did you originally invest in it? What I'm trying to say is there's no internal consistency within accounting. Different assets get listed at different numbers. The internal consistency is an accounting consistency, but it's not a consistency that anybody else in the world would look at and say, that makes sense. And finally, let's talk about intangible assets. Sounds so glorious, right? I mean, let's not think like accountants. Let's think like regular people. What's Coca-Cola's biggest intangible asset? Jane?
The brand name.
Let's face it, it's not the syrup. They could give away the syrup. It's a brand name. Cody, what's Apple's biggest intangible asset?
It's brand name as well.
And it's styling, and it's, I mean, so, but basically it's technological advantages. What I'm trying to say is if you take the 10 largest companies in the world, maybe 8 or 9 of them, maybe all 10 of them get the bulk of the value from things you cannot physically see, right? So let's start out by conceding most of the value of many large companies comes from intangibles. So an accountant say, we want to show intangible assets on the balance sheet. Sounds like a good idea, right? At the start of every year, I download the publicly traded company and data on every company in the world. And I look at what shows up in an accounting statement. You know that 85% of the intangible assets in accounting balance sheets around the world, 85% come from one item. Daniel, you know what that item is? What is that one item that accounts for 85%?
Goodwill.
Goodwill, the most ridiculous and destructive item ever created. Sounds like an overstatement, right? But let me back it up. For a company, for goodwill to manifest itself on a company's balance sheet, what does a company have to do? It has to do something. If it doesn't do this, goodwill can never show up. Crystal, you want to try? What does a company have to do for goodwill to manifest itself on an accounting balance sheet?
They have to buy a company.
Exactly. They have to do an acquisition. The minute you do an acquisition, goodwill magically pops up. And here's how it shows up. You have a company that's worth 4 billion. That's basically the book value of the company is 4 billion. Somebody acquires the company for 10 billion. The accountant has a $6 billion problem to explain away. Do you see what I mean by that? Until yesterday, what was the accountant telling you about the target company? It's worth 4 billion, it's worth 4, oops, it's worth 10 billion. So you know what he does? He takes that $6 billion difference, he puts it in the balance sheet, he gives it a name, or her if it may be, calls it goodwill. Goodwill is a plug variable. It exists for one reason and one reason only, which is you need balance sheets to balance. Can you imagine opening up a financial statement, it says unbalanced sheet? Wouldn't have much credibility, right? Goodwill is a plug variable. The only problem with goodwill is it sounds good. And you know when something sounds good, what people feel the urge to do? They feel the urge to pay for it. Every week I get at least a couple of emails from people valuing companies saying, I'm valuing this company that's $10 billion in goodwill. How much should I pay for goodwill? You feel like slapping the person around the face saying, wake up, it's a plug variable. What the heck are you doing thinking about paying for it? Every year I actually send these suggestions to the accounting rule writers. They never seem to take me up on my suggestions. About 8 years ago, I sent a suggestion to both GAAP and IFRS saying, you know what? I propose we change the name of goodwill. In algebra, we have two numbers that don't equate. How do we make them equate? We put X in there, right? X always fills the gap. I said, why don't we rename goodwill X? Can you imagine opening up a balance sheet and saying X is 10, but you would feel the urge to pay for X, but that's how much is behind goodwill. And on the other side of the balance sheet, of course, accounting balance sheets are littered with a breakdown of short-term debt, convertible debt, long-term debt, other stuff that they make up. Underfunded pension obligations, healthcare obligations, tax due, and of course, shareholders' equity. Sounds glorious. But since we're talking about Coca-Cola, let's say Coca-Cola. When you look at the shareholders' equity for Coca-Cola, what is that shareholders' equity measuring? Vamsi, you want to try? What is the shareholders' equity for Coca-Cola measure? Unmute yourself, please. Okay, there now. What does it measure?
Can you hear me?
Yep.
How much their assets are worth after
Wait,
they've paid all their debts?
Pause right there. Is that what it's measuring? If it did, it will actually make sense, right? Dan, what is it measuring?
Everything they've ever done.
Everything they've ever done. It's a historical recording. That IPO of Coca-Cola, when did that happen? 100 years ago? It's in there. Every retained earnings they've had since their inception is in there. You see where I'm going? Shareholders' equity in an accounting balance sheet is the ultimate backward-looking number because it reflects your past as a company. You had a glorious past, you could have a glorious book equity. So I'm ready to narrow down my critique of why we're not accountants in this class. Accounting is rule-driven. You see what? Everything in accounting is driven by a rule. If you don't believe me, just pick up the gap book, see how many rules there are. But basically, accounting is really business for 6-year-olds, right? Don't do this, don't even think about doing it. It's rules. And the second, it's backward looking. It's not their fault. That's their job. It's backward looking. So here's the first thing I want you to do. I want you to replace the accounting thinking with what I call a financial balance sheet. Looks a lot like an accounting balance sheet, right? You got assets, you got liabilities. But here's the difference. In a financial balance sheet, if you look at the asset side, you see how I break down assets? I break them down into investments you've already made as a company. I call these assets in place and growth assets. You're saying, what are growth assets? This is the value that I'm attaching to what I think you will do in the future. I'm giving you credit for investments you haven't even thought about yet. You're saying, that's absurd. Why would I do that? Anytime you invest in a growth company, think about what you're paying for. You're not paying for what they've already done. You're paying for what you think they will do in the future. Now, part of you is saying, that's speculative. That's an absurd word. What does that even mean? Of course, it's in the future. Let's make it real. You guys familiar with Airbnb, right? I mean, who's not? You know, it went public late last year. It's got a market value of $100 billion. Forget about the market value. Markets could make mistakes, but let's take Airbnb. I want you to think about Airbnb on the one hand, and I want you to think about Marriott on the other. Two hospitality companies, right? Very loosely using the word hospitality. Think of the breakdown of value. When I show you Marriott as a company, even if you're an upbeat optimist on Marriott, where does the bulk of the value for Marriott come from? Investments they've already made or investments you expect them to make in the future? Anybody?
Investments they've already made.
Investments they've already made, right? Whereas if you take Airbnb, you can debate what the future is worth, but the reality is the bulk of your value comes from what you think they will do in the future. Doesn't make one company good and the other company bad. It just means your value comes from different places. Whenever I look at a company, that is my starting point. So when I look at GameStop and AMC, what do I see? Companies who the bulk of the value is going to come from investments they've already made or growth assets. What I see are mature companies where the bulk of the investments are made. Maybe you have a story you can tell me about how GameStop is going to reinvent itself as a gaming platform and become a growth company. But we're way off the reservation with that because where is the basis for that story? And on the other side of the balance sheet, there are only two ways you can fund a business. You can borrow the money or use your own money. Let's not get too fancy and call these stocks and bonds. You start a business, where are the two places you can go? You can go borrow the money from a bank where the bank is going to say, why am I lending you money? You have no income. Or you can use your own money. And by your own money, I'm using an extension of your, which is, it could be your parents' money, your friend's money. But basically, we call one debt, the other equity. Hold on to this structure because I'm going to use this to kind of illustrate many of the issues we run into. Remember earlier I said this is a big picture class. Let me be very specific about why I call it a big picture class and show you the big picture. You're going to see this page probably 25 times through the course of this class because everything that I will do in this class is in this page already. And I'll make a confession. Once this class is over, I don't care if you forget every detail in the class if you hold on to this big picture. So I'm going to compress what I think corporate finance is all about into one page. Corporate finance covers three groups of decisions: the investment decision, the financing decision, the dividend decision. And with each one, let me lay out the principle that's going to govern how we think about that decision. The principle, not the details, and some sub-principles. Let's start with the investment decision. Here's what corporate finance says. When you as a business go out and make an investment, it could be a project, it could be an acquisition, it could be whatever investment, make sure that investment earns a return that is higher than your minimum acceptable hurdle rate. Already I've thrown a buzzword in there, right? You're saying, what the heck is a minimum acceptable hurdle rate? I'm not ready to delve in the details, but let me give you the sub-principle that drives that. The hurdle rate you use on an investment should be based on the risk of the investment. Riskier investment should have higher hurdle rates than safer investment. Think about it for just a moment and tell me whether you're surprised by what I just said. If I come to you with a safe investment, you're saying I'll settle for 6%, but if it's a riskier investment, you might need to make 10 or 12 or 15%. So your hurdle rate should reflect the risk of the investment as well as where you get the money. You're saying, what do you mean? There are only two ways you can raise money, right? The debt or equity. The mix of financing use could affect your hurdle rate. And when we talk about returns in finance, we're not basing it on accounting income. It's based on cash in and cash out. It's a much more honest way of thinking, did I make money? You know how many people go bankrupt with their accountant saying, you're making a lot of money? Quite a few, actually, because you run out of cash. In finance, we're focused on cash flow. We care about when we get the cash flow. And when I state this, tell me whether there's anything that surprised you. Would you rather get the cash flows earlier rather than later? I would. And in finance, we say we're going to factor in when you get the cash flows and incorporate all side effects into those returns. There's no garnishing in investment analysis. You know what I mean by garnishing? Many of you have worked at companies. You've looked at a project. The project doesn't pass muster, but you still take it. Why? There are strategic considerations. Most dangerous word in business, strategic. You know what it means? The numbers don't fly, but I really, really, really want to do this. Strategic synergy, real options, platforms, ESG. I mean, you can throw in every buzzword you want. My job in finance is to bring it into the numbers and make sure the numbers reflect them. That's the investment principle. The financing principle is very simple. I said there were two ways you can raise money. You say, what's the right mix for me? It's a mix that minimizes your hurdle rate. You'd rather have a lower hurdle rate than a higher one. And if I can find a way to get a better mix for you that minimizes the hurdle rate, you're going to be able to take more investments that are going to be worth more. And if you ask me, what kind of debt should I use? I'm going to turn the question back on you. I say, what kind of investments do you make? What kind of projects do you have? And here's why. If you tell me that you're Boeing and your typical project is 30 years, you know the right kind of debt for you is really long-term debt. You ask me, what currency should the debt be in? I'm going to turn the question back on you and tell me something about the currency of your cash flows. You get 60% of your revenues in Europe. I think 60% of your debt should be Euro debt. This isn't rocket science. The right type of debt for you as a company is the one that matches your assets. That's a financing principle. And finally, you get to the dividend principle. You know what it says? The end game for a business is not survival. One of the stupidest concepts I've seen in business is the notion of corporate sustainability. I said, the end game for a business is just stay around. That's like the Egyptian pharaohs saying, I want to live forever. So you know how they ended up trying to live forever? They wrapped themselves once they were done with ribbons, got put it in, basically the mummies were created. And you know what? They died anyway. The dividend principle says if you cannot find investments that meet your hurdle rate, give the cash back to the owners of the business. So if you run a private business, what am I saying? If you can't make any money on the business, take money out of the business. Don't keep throwing money into the business saying, I want this business to survive at any cost. Now, whether you choose to return the cash as dividends or buybacks, and I'm going to argue there's just two different ways of returning cash, is going to depend on the kinds of stockholders you have as a company. And again, it's not complex. If you're a company that has a history of paying dividends, you have Verizon, and you have a lot of cash to return, pay it out as dividends. If you're a company like Google or Amazon that never pays dividends, don't pay dividends. If you have extra cash, buy back stock. That is corporate finance on one page. I know we're getting towards the end of the class, but let me lay out some broad themes that are going to emerge from that financial balance sheet and from that big. And in doing all of this, you have a singular objective. Let me take you back. You have a singular objective in corporate finance, which is you want to make your business the most valuable business you can. The most valuable, not the biggest business, not the longest lasting business, but the most valuable business. So with that set up, let me lay out the themes for corporate finance. Think of what I've just said. I said, if you can raise money at 9% rather than 10%, please raise it at 9%. Are you surprised by that? Did you have to take a corporate finance class to learn that? And once you raise the money at 9%, please don't go take projects that make 7%. You're saying, I knew that already. Guess what? You guys already know corporate finance. My job is to give you a structure on what common sense tells you and put it into that bigger structure. And why should that surprise you? You know how old corporate finance is as a discipline? It's 62 years old. You know how we can date it so precisely, right? Until the 1950s, if you took a corporate finance class anywhere in the world, you basically got a glorified accounting class. You think, what happened 62 years ago? Two professors at the University of Chicago, Merton Miller and Franco Modigliani, both of whom have won Nobel Prizes since, wrote a paper on, hey, what's the right way to think about how much debt to take on? How does debt affect value? Now, we can debate that paper, and we'll talk about it later in the class, but that is the paper that gave birth to corporate finance as a discipline. So corporate finance is 60 plus years old. How long have people been running businesses? I'm sure there was a very enterprising cave person who probably went around there, tools for sale, fire, new invention, disrupting the world. See where I'm going? Good business people through the ages have always understood these first principles. They don't need a corporate finance class or a book to get it. You know, when India's largest company, Reliance, was founded by a man called Dhirubhai Ambani with a 5th grade education. But I promise you, Dhirubhai Ambani got those corporate finance principles at the core. Conversely, there are people with MBAs and PhDs wandering around, many of them in New York and London and Tokyo and Frankfurt, who somehow think the principles don't apply to them. Why? Because they're special. They went to the right school, they've got the right degrees, they've learned all the right things. They say, that's so old-fashioned. That thing about taking projects that make returns higher than your hurdle rate, that was so yesterday. We've had a paradigm shift, which basically means I've just made up stuff. Now you can do different things. Corporate finance is common sense. So what I'm trying to say is, as we go through this class, when we talk about something and you understand the logic of what I do, but the intuition is still slipping by you. I want you to stop me. Because I want your intuition to kind of at least match up to that logic for it to stick. Second, corporate finance has focus. You know where the focus comes from? What did I say the end game for every business was? At the top of that big picture, what did I have? Maximize the value of the business, right? Everything we do in corporate finance, I can pass through that prism. Will that increase value? The answer is no, it's not a good decision. So when we get to investment decisions, we're going to talk about different metrics we can use to decide whether a project is a good project or a bad project. I'll give you a choice of 8. You know how we'll decide which one's the best one? Whichever one is most consistent with increasing value. When we get to the financing decision, the dividend decision, every step of the way, all I have to do is, if I do this, will this increase my value? It's that focus gives me the capacity to make a choice, but it comes at a cost. You know the cost is? Where does this focus come from? That objective of, hey, my objective in a business is to maximize value. If you disagree with that objective, you know what's going to happen? Nothing in corporate finance will make sense. So here's what we're going to do. The first 3 or 4 sessions, we're going to spend our time focused on that objective. Because the mistake I think we often see in corporate finance is people state the objective and then they move on. And people say, I don't like that objective, but it goes to the background. I'm not going to allow that to happen. I want us to bring our differences to the front. So if you believe that the objective of a business is to maximize good done to society, maximize customer satisfaction, I want that to be out there. Let's talk about it. You might not end up agreeing with me, but at least we know where we're coming from. When you think about differences, that's where it's coming from. Third, I'm going to use a structure, and this is like my financial balance sheet structure I go back to over and over again in every one of my classes. I believe companies go through a life cycle. Let me explain. Like human beings, companies go through a life cycle. A startup is like a baby, right? Needs a lot of care and attention. A very, very, very young company is like a toddler. What do toddlers do? They fall, they get up, they fall, they get up. Sometimes they fall and stay down. That's what toddler companies do. Then you go through toddlers, you get to be a teenager. What do teenagers do? Every morning they wake up and say, I have lots of potential. What can I do today to screw it all up? When I bought Tesla shares in June of 2019, and I'll send you the link to that at some point in time, I said, this is my invention in a corporate teenager. I know there's going to be a lot of heartache down the road because Elon Musk is going to wake up every day and say, what can I do to screw it all up? But there's enough potential here that I can live with it. You have corporate teenagers. And then you're at the peak of your life. Everything is effortless. Everything you touch turns to gold. You make money without even trying. This is Google and Facebook in 2017, maybe 2018, right? Market cap zooming, they make 40, 50% margins. They don't even have to try to make money. They just make money. Enjoy that moment. It will not last. I mean, you guys are closer to the peaks of your lives than I am. Much, much closer, which means you can go to bed at 3, wake up at 6, and be a functioning human being. If I went to bed at 3 and woke up at 6, I would be a wreck. Because you know what comes after the peak of your life? You get middle-aged. And when you first get middle-aged, what's your reaction? This stinks. It's terrible. I have to go to bed at 10 to be a functioning human being. Where did this happen? Enjoy that moment too, because worse things are coming down the pike. Because after middle age comes old age. And while you're complaining about old, there is a fate worse than being old, which is you're dead. I know it's a morbid thought, but companies go through this cycle. And one of the things I'm going to argue is if you can put where your company is in the life cycle, corporate finance kind of flows out of it. For instance, if you're a young company, an Airbnb, remember we talked about the investment decision, the financing decision, and the dividend decision. Help me out here. Does it matter where Airbnb makes its investments? Bulk of its value is from the future. So if it makes bad growth investments, of course, it's going to matter a lot. We're going to talk a lot about now how should you, so when you look at Airbnb, the focus is going to be the investment decision. But help me out here. How much money should Airbnb borrow? How much money did Airbnb make last year? That's a trick question because it lost $1 billion. So let me reframe that question. When you're losing $1 billion, how much money should you borrow? The answer is obvious. Don't borrow money. Why? Because you're putting your future at risk when you borrow the money and your entire value. So how much debt should Airbnb have? 0. Let's keep going. We talked about the dividend decision. How much dividends should Airbnb pay? Or how much should it use buying back stock? When you're losing money of negative cash flows, you can't borrow money. You can't buy back stock. You can't pay dividends. So for Airbnb, it's all about the investment decision. Right? As you mature, though, your capacity to borrow money will improve because you're making money. So there will be a point, and for Apple, it came in 2012, where they said, you know what? We can borrow money. We should be borrowing money. We can pay dividends. You see what I'm saying? If you think about where your company falls in the corporate life cycle, you can already start to draw judgments on whether that company should be borrowing money, should be paying dividends, should be buying back stock. So I'll leave you with the fourth theme, and we'll leave the fifth theme to start off next session. When I say the word corporate finance, what's your first reaction? This must be finance for corporations. That's unfortunate because this is really a business finance class. What did I say the 3 big decisions were? Investment, financing, and dividend decision. I know you're not in New York, but if you do go by Stern, walk out in the sidewalk in front of Stern, there's a guy who sells hot dogs. He's been around for 25 years. I still remember when he used to stand outside his cart in one of those small carts and make his food. And then he invested in this bigger cart where he could be inside in winter. Great plus. I remember seeing it and saying, hey, this is great. And he said, it's very expensive. It costs $50,000. Big investment decision. Huge investment decision. The day he added sausage to the menu, big decision for him. He needs to think about investment decisions even more than a typical company because he has no buffer. I said, where do you get the money? He said, I borrowed $20,000 from the bank. I asked him, did you compute your optimal debt ratio? And he said, no, I just had to borrow the money. I don't have the capacity to go out and raise equity. I don't have that much money. The financing decision. And he has 2 kids who go to college. One in State University of New York, upstate, and one, I think, down in the South somewhere. And he has to pay college tuition. You know how he pays for tuition? The cash he extracts from business, the dividend decision. Everything we talk about in this class applies to any business, small or large, private or public, developed or emerging market. And when I start class next session, I'm going to talk about how I'm going to try to bring this universality when we talk about individual topics. But we're out of time, and I will see you on Wednesday. So be ready for the email at the end of class today because we'll talk about a recap. So take care. And as I said, if it looks like I'm running, it is because I'm running because I have to get to my next class in 7 minutes. So see you soon. Take care.
Thank you.
Thanks,
Thank you.
Professor.
Bye.
Thank you.
You.